The moment you finance a car, the bank owns a piece of your future. And most people never notice. When you finance a car, it feels like a favor. The approval comes quickly. The process feels smooth. The payment feels manageable. It feels like someone is helping you move forward. But banks don't help people out of generosity. They help when it benefits them. And what they gain from car financing has very little to do with the car. Banks don't care what you drive. They care about what you commit to. Because the moment you finance a car, you've done something extremely valuable for them. You've promised a piece of your future. Not once, not occasionally, every single month, for years. That promise is the product. From the bank's perspective, a financed car isn't transportation. It's a predictable stream of cash. Predictable cash is gold. It doesn't fluctuate with the market. It doesn't depend on mood. It doesn't wait for good timing. It shows up on schedule. That's why banks love monthly payments. They don't need you to be happy. They don't need you to be thriving. They just need you to keep going. Here's the part most people don't realize. When a bank approves your loan, they're not asking, is this good for this person's life? They're asking, how likely is this person to keep paying even when it's uncomfortable? That's a very different question, and the answer is usually yes, because people will sacrifice almost anything before they give up their car. They'll cut vacations, they'll cut savings, they'll cut rest, but they'll protect the payment. Banks know this. They know cars are emotional. They know people attach identity to them. They know giving one up feels like failure. So the loan becomes sticky. Once you're in, you'll do almost anything to stay in. That's incredibly valuable. Another thing banks gain is your tolerance for pressure. Car loans are training tools. They teach you to accept fixed obligations as normal, to budget around debt, to plan your life around payments. Once you've proven you can do that, you become a better customer. You're more likely to finance again, more likely to upgrade, more likely to stack obligations. Each loan makes the next one easier to sell, not because you need it, but because you're used to it. Banks don't need you to be reckless, they need you to be compliant, and monthly payments create compliance. There's also something else happening quietly. While you're focused on the car, the bank is focused on time. Longer loans mean more exposure. More exposure means more profit, even at lower interest rates. That's why loan terms keep stretching. 5 years becomes 6, 6 becomes 7. The payment stays affordable, but the commitment grows. From your perspective, nothing feels different. From the bank's perspective, they've locked in more of your future. And future income is the most valuable thing you have. It's not your current balance, it's what you haven't earned yet. When you finance a car, you're pre-spending that future. Banks love that. Because future money can't argue. It can't change its mind. It can't say no. It just arrives and gets redirected. Another advantage for banks is asymmetry. If life goes well, they get paid. If life goes badly, they still get paid. Or they take the car and sell it. The risk is managed. The upside is consistent. Meanwhile, you carry the uncertainty. You're the one hoping income stays stable. You're the one absorbing stress. You're the one adjusting plans. The bank just waits. This is why financing feels painless at the beginning. All the pain is deferred. Deferred pain is easier to sell than immediate sacrifice. And once you're inside the agreement, the rules change. You stop asking if the car was worth it. You start asking how to make the payment work. That shift is everything. Because now your energy is focused on maintenance, not evaluation. Banks don't want you evaluating. They want you continuing. This is also why banks don't push hard for early payoff. They'll accept it, but they don't encourage it. Because the ideal customer is predictable, not free. Predictable customers are profitable. Free customers are not. None of this makes banks evil. It makes them logical. They're doing exactly what they're designed to do. The problem is that most people don't realize what game they're playing. They think they're buying transportation. They're actually entering a long-term relationship with an institution that benefits from their consistency. That relationship shapes behavior. You become more cautious, more risk-averse, more focused on stability over growth, not because you want to, but because you're obligated. That obligation is the real asset, not the interest, not the fees, your reliability. Your willingness to keep going. And once you see it that way, financing a car looks very different. It's not just a loan, it's a claim on your future flexibility. Banks gain peace of mind. You gain a schedule. Banks gain predictability. You gain pressure. And the longer the loan lasts, the more one-sided that trade becomes. This doesn't mean you should never finance a car. It means you should understand who benefits the most when you do. In the next video, we're going to talk about a question most people avoid because it's uncomfortable. What happens to your car if you lose your job tomorrow? And why that single scenario changes how smart the decision really was. If you want to stop playing a game you didn't agree to, stay.